Good morning. My name is Bruce Finsilver from 21st Century Financial Group, and I'm here this morning to answer your questions about insurance. So if you have a question for me.
Hi Bruce, Jordan Tracy, how much life insurance should a person have?
Thank you, Jordan. The question is, how much life insurance should a person have? Surprisingly, I'm not asked this question very much because people come to me and say, I'd like to buy a $250,000 life insurance policy or a $500,000 life insurance policy. But every insurance company, when they evaluate an applicant, determines an amount of insurance that they will insure them for. Okay? Generally, it's around 20 times your income. And my question is, why would you take less than the insurance company is willing to give you? Using other people's money can secure your family's financial future for 2 or 3 generations. I look at it as if you went to the bank and asked for a $250,000 loan, and the banker said, we like you so much, we'd loan you $1 million. Would you settle for $250,000? You shouldn't. I mean, if they're going to give you $1 million, lock in the rate, take what you can at the opportunity. The next time you may not be offered as much and at a different rate. So I always say take as much insurance as the insurance company will give you. They will not let you be overinsured. Another question?
What percentage of my income should I put towards life insurance?
Well, the question is, what percentage of my income should I put toward life insurance? It's somewhat of a complicated question, but the problem here is that people, when they pay a life insurance problem, tend to pay it out of what I call their lifestyle pocket. And they view an insurance premium as competition for lifestyle. If I didn't pay this premium, I could go on a better vacation, or I could go on more vacations, or I could go out to dinner more often. And the real answer is this. The goal is you should be spending 20% of your income on savings and investment and retirement. And your insurance premium should come out of that pocket, not your lifestyle pocket. So with a good planner, help you integrate your retirement and savings plan, that's where your life insurance premium should be. Another question?
Yeah, Bruce, what is the mortality rate for a 53-year-old male? Hoping it's not 54.
The question was, what is the mortality rate for a 53-year-old male? The last time I looked at the table, it was 100%. Okay? Everybody's life mortality rate is 100%. The only question is it going to be sooner or later? For most people, it will be later. We all hope it will be later, but life often gets in the way. So the only question is not if, the only question really is when. Another question.
Thank you.
Bruce, should a person purchase term or permanent insurance? And what about buying term and investing the difference?
The question relates to the old expression we've always heard, buy term and invest the difference. First part of the question is, first have as much insurance as you can get. But I sort of like to use an analogy. If you looked at 2 runners and they were running a marathon, and in lane 1 is a runner that we call permanent insurance. Okay? And he's kind of perceived to be a little bit slower than the runner in lane 2, which is buy term and invest the difference. Now, that second runner, however, has 3 handicaps. First handicap is he's dragging an anchor. That anchor is called income taxes. The second handicap he has is as he's running along, he has to pay the term insurance premium. And the farther he runs, the more expensive that term insurance premium gets, till eventually it becomes a very large burden, and he has to decide whether to keep paying it or drop it. And the third handicap he has is every once in a while an official will run out and say, oh, you have to run in place for a little bit. The economy has slowed down, so he has to run in place a little bit. And sometimes that official will run out and say, well, actually you have to turn around and run backwards. And then at some point you'll be able to run forward again. So the question is, who is going to finish that marathon first? Okay. In all likelihood, it's the runner in lane 1, the permanent insurance. Now, sometimes the runner in lane 2 will win, but not very often. But we're also really looking at this is that most people assume it's an either-or question. I can buy permanent insurance, or I can invest and buy term and invest the difference. The real way to do it is with a good planner, is you integrate it, and you actually have both runners running for you. You have the permanent insurance runner, and you have the second runner, but he now loses one of the burdens. He doesn't have to pay for the term insurance. He still has the anchor with income taxes. He still has to go backwards. He still has to slow down. He still has to go forward. But really, you should have both runners running for you. You should have the permanent insurance runner and maybe 2, 3, or 4 runners in the other lanes. Okay? They are just not mutually exclusive choices. Any other questions?
Sure, Bruce, what is the biggest mistake that people make in your industry?
Great question. The question is, what is the biggest mistake people make? Biggest mistake that people make is ignoring disability insurance. They focus on life insurance and ignore the fact that many people become disabled and don't die. And trust me, if you become totally disabled and don't die, you will wish you had died. Okay? Because you need something to replace income. And this is probably the most underinsured market there is. People just ignore disability insurance, and chances of becoming disabled during your working lifetime are actually quite high. So to support your family and support your lifestyle and continue your life, you really do need to have disability insurance. Any other thoughts or questions? All right. Well, thank you very much.